Welcome to Freed on Business. He grew up in South Florida, has been in business here since the early 90s, and has closed over $3 billion in deals. He's seen it all. He always has an opinion, and he's always ready to share it. Informed, entertaining, and connected, he has his finger on the pulse of South Florida's business community. He's Jim Freed, and this is Freed on Business.
Hello, everybody. Welcome to episode number 846. We're going to be on with our old friend, Tom Handler. Tom is the top wealth protection attorney in town. Let me rephrase that. The top wealth protection attorney in the world. Sorry to limit Tom's expertise, but Tom has been on many times. We're going to talk about all kinds of wealth protection topics. It's going to be a tremendous show. I want to remind everybody, we're streaming live on LinkedIn, YouTube, Facebook, Twitch, and Instagram. Follow us at Freed on Business or at Jim Freed. Remember, we've got Warren Henry sponsoring us for probably 14 years. We're been on for about 16, 17 years. And one of our most visited guests is Tom Handler. And with that, I want to bring in Tom Handler. Tom?
Good afternoon, Jim. How are you? It's a pleasure to be on.
Oh, always a pleasure to have you, Tom. Thank you so much for joining us. You're in Chicago today?
I am, where we had about 2 inches of snow last night, a little bit this morning. So it appears that after 2 weeks of mid 60-degree weather, winter has finally arrived.
Well, I'm sure you'll be on your plane to Arizona sometime soon then.
I'm looking for warm locations. They're in my future.
Well, as I said, and I'm sorry for limiting your scope to just the top wealth protection attorney in South Florida. It is the world. You're repeatedly recognized. We're thrilled to have you on the show. And there's been a bunch of different updates, changes, and evolutionary situations that have occurred. So I'm just going to throw it to you and ask you, what's on your mind?
So first, thank you. For the first time, a list was published of the top 50 advisors in the world to family offices, family businesses, and other family enterprises. And I was one of 4 attorneys named that list. So that's always good stuff. My mom and dad would be very proud. But the point is that there's sort of a global perspective. The world is increasingly flat. And there was an article that came out recently in the Wall Street Journal, and it talked about the U.S. lead in billionaires, and the U.S. has more billionaires than like the next dozen countries combined. And our collective billionaires have about 13.4 trillion. And the states keep trying to put in millionaire taxes or billionaire taxes, like Illinois has proposed it. Massachusetts put it in successfully. And the minute they put those taxes in, clients call and say, how fast can we move out of here to go someplace else? And just like you benefited on Brickell Avenue with my friend Ken Griffin leaving Illinois, one of the biggest taxpayers in Illinois, with a huge enterprise, with tons of employees making 7 figures, huge Illinois taxpayers, and they left because they got tired of our government, which admittedly has been a one-party rule for about 100 years. And now we're leading the charge in incompetent one-party rule. So we're very special. But the reality is that wealth continues to accumulate. And no matter what political system you put in place, that continues to happen. Since the history of the world, you continue to have the people with the capital increasing and growing. But these people, unlike the public perception, they're creating tons of jobs. They're creating businesses. They're paying massive taxes. They're inordinately charitable. Some of these families give everything to charity, not just 50% when they sign the Gates Pledge, but they actually are giving everything. We have a number of those families, guys in their 70s working 60, 70 hours a week, and 100% is being given away. Nothing is going to their family. So these people are really working for us. So these proposed taxes to put an extra tax on billionaires, either income tax or estate tax, or the Massachusetts proposal, the enacted law, they charge an additional tax on anybody who's a millionaire. Well, we've moved a number of people out of Massachusetts and a bunch more are going. So the bottom line is that people can vote with their feet. And so when these states and local jurisdictions continue to put in taxes in increasingly heavy on the top 1% or top 10%, they leave. And some leave the country. They just leave altogether. In Europe, many of these countries have tried these taxes. They haven't worked anywhere. Everyone leaves immediately and goes someplace else. So jacking up the tax rate is not the solution. Of course, no government ever considered cutting anybody, like, you know, the hundreds of people not doing their job that never show up, that are incompetent, should have been hired in the first place. The idea of cutting anybody has never occurred. Government just grows and grows and grows and grows with no end in sight. So it's a mistake, and you can't put in these confiscatory taxes. Meanwhile, in 2023, the bottom 60% of the U.S. paid zero income tax. Zero, not a nickel, as opposed to the top 1% and 10% who are paying the huge percentage of all taxes combined are coming from that particular group. Real estate taxes, which are extremely oppressive and confiscatory, on top of the income tax, and nobody pays the estate tax but about the top 10% anyway. So it's a huge burden. So in view of that burden, people are continuing to work hard on tax planning in general of all sorts, every kind of tax. And in the current environment, which is increasingly becoming very far left liberal, beyond progressive, into communist, including the new mayor of New York, who's very special, by the way. He's never had a job in his life. He's completely incompetent. He shouldn't be running a lemonade stand. And the Chicago mayor, kind of the same boat. The guy actually worked as a horrible teacher, has no real experience, and of the 18 candidates according to the Wall Street Journal, was the least competent by far. And who's our mayor? The guy who was a horrible teacher, passed everyone, didn't take attendance, didn't give tests, in what is either the 5th or 6th worst public school district in the country. And those teachers gave him $2.4 million, I believe was the number, to get him elected, which is just a complete shame. So with leaders like this and this increasingly socialist entitled surge of young people who don't move out till they're 32, never had a job, poor decision makers, more entitled, affluent people and high income people are running for the hills. They're running for cover. So everything from more insurance, special risk insurance, captive insurance policies, asset protection, more money in pensions, hiring security, leaving dangerous areas where the mayors won't let the police do their job. You see this real run for cover. And that's what the environment is out there, that these people are feeling the pain. And then when there's no police around and the police aren't doing their job and they're being vilified by the media, who typically has no clue what's actually happening because they don't have backgrounds in economics and taxation and accounting or finance. They're all journalism, type majors who don't even have the background. That includes the Wall Street Journal, some of the finest publications in the country. These people are writing about things they truly know nothing about. And I've been quoted maybe 18 times, in those kind of publications, and they get it right about half the time, but several times the premise is dead wrong. They said, "This is what our editor told us, that if you publish that, you're going to embarrass yourself. That's not how it works. Here, call 3 other lawyers will tell you the exact same thing I just told you." So the lack of information, this entitled new, I've never worked, I'm a bad decision maker, I'm a worse problem solver, I'm pretty entitled, all of this bodes not well for business owners and affluent families. And that's what's dominating the marketplace in a nutshell.
So, Tom, first of all, I want to thank all those people you just mentioned for making the great state of Florida even more successful.
We're just here to help, just so you know. We're just trying to help Florida.
Please. We're so thrilled that they exported Ken Griffith and all of his jobs and millions and billions of dollars. I can't wait for his building to to go up. And he just donated $20 million to Vizcaya. But I have a question for you. And here in Florida, they're trying to eliminate property taxes. They're saying, the local governments are saying that this will gut the local governments. We have the person that's running for, I don't know what the exact title is, but he'd be the CFO of Florida, running around from county to county, talking about efficiency and doing a statewide Doge, if you will. What are your thoughts on property taxes, the alternatives to property taxes, and the implications for property taxes on local governments in Florida.
So I have a couple of mixed views, so I'll just share them. So first off, I've always resented property taxes because I'm paying over and over again for a building I already paid for. So just by owning my property, I continue to pay again and again and again and again and again just because I own the property. So in effect, the real estate property tax is a wealth tax and wildly unpopular for that reason. And the fact that I can deduct virtually none of it makes it even worse because it's all bearing on me. That deduction got taken away by the original TCJA in the first Trump administration. And it's a great punishment to the irresponsible blue states that are mostly bankrupt. I get why it's not really the states. You got 50 Republican states and you got 30 communist cities. Therein lies, the issue. So they're trying to punish those jurisdictions because what? They ignore the law. They're sanctuary cities. They don't want the National Guard. They don't want this. They don't want to follow. They want to make the rules up as they go. And I think that's okay. Well, they took an oath to uphold the Constitution, which means you don't get to decide if illegal aliens are illegal. They're illegal. They have to be deported. And then instead of giving grief to ICE, how about upholding the law that you took an oath to swear to uphold? But no, that's not how it's played out. So I think in general, the situation is such that people are waffling between the unpopularity of that tax, and yet the local organizations most have no mechanism. Unlike New York that has state and local taxes, and some places do, but it's a tiny minority. The burden of that administration now would fall solely on these jurisdictions as opposed to a county doing it, which is what typically happens now. So there would have to be some modifications to the process. However, the county might still be able to impose those taxes in a different mechanism in order to keep the state and the local people in the same place to fund the schools and the park districts and the police and the necessary things for that area. Conceptually, if we got away with the real estate tax, I'd be a lot happier because I don't think it's a fair tax. And I don't think I have to pay for my property that I already own over and over and over again in perpetuity at really ridiculous rates. And of course, in Illinois, we're like 22,000 per million, and a couple of $1 million buys you a shack with barely running water. So the taxes are extremely high. We're consistently in the top 5 highest real estate taxes in all of North America. And places like New York and San Francisco and Chicago are in a different boat than most other parts of the country. I could move outside of Denver, buy 6 times the house on 10 times the property with 10% of the real estate tax, to put it in perspective, right? So these taxes are really onerous, and the fact we can't deduct them makes them painful as can be. That seems to be unfair in itself. So if it's going to be there, at least make it deductible. I would rather have it dissipate. So I'd love to see it go by the wayside, but I can't imagine that the bankrupt blue states will ever consider it because they and the counties and the local municipalities need that revenue desperately. Interesting idea. I'll see how it goes in Florida.
Well, I'm sure that that our governor is going to use it as one of his planks as he tries to resuscitate his national profile. We don't really do politics on this show, except whenever we have you on, Tom.
I'm not one to withhold my views. I'm too old and crabby. I just don't care.
That's okay. I think that most of our viewers really love your views and see many, many things your way. And just getting back to your good friend Ken Griffith for a while, like I said, he's been an absolute boon to charity. His name is on the new cancer building here. He's done lots and lots of jobs helping rebuild schools, both directly and indirectly, and opening up brand new businesses all the time. If he's an indication of the type of person that's moving here, all I could say is thanks, send us more. Now, we're here approaching the end of the year. It's when we usually get you on and give you the chance to give people some free advice for whatever it's worth. What do you think? What do you think are a couple of things, given the current tax laws as they may be, rather than what we would see next year. What do you think are a couple things that people should do? For instance, should they be deferring their income until 2026?
I think in general, things are pretty much status quo between this year and next year. We were concerned until this TCJA got extended. That's the act that, among other things, created the 21% corporate rate, which has been highly responsible for keeping U.S. companies from inverting offshore or shipping money offshore or keeping money offshore and not bringing it back. That's still a relatively high rate. There are countries that, 13, 14, 15% that are even more competitive. So you could argue it'd be even lower. But at 21, given all the benefits of the U.S., that's probably enough to get 85% of the companies thinking of leaving their cash offshore or inverting the company back. And I want to say, like out of the Fortune 500, I want to say maybe 140 are still here. They've all left, right? They all inverted. That was a bad thing. That was before this bill was passed. So the fact it was extended is the right thing over the long haul. Trump and his advisors were very astute in doing this. That tax should have been lowered a long time ago. And Reagan was very effective doing the same sort of thing. Coming out of that awful Carter recession, they got out very, very quickly using the same sort of stimuli and deductions. I think that the rates for next year will be roughly the same. There's roughly a 2.7% overall adjustment, not much. So there's really no reason to defer your taxes to next year other than to get the time value of money. If you've got some good investments going, you may want to push it off and prepay your expenses this year to knock your income down, or bubble your expenses into 1 year where you can get a deduction where you might not get them if they're split into two. And so any cash basis taxpayer can prepay at year end and of things that are deductible, including businesses, and be able to get those deductions on their 2025 returns. The 10% rate goes up to about $25,000. 12%, just over $100,000. 24% to over $400,000. The 32% bracket runs up to over $500,000 in income per year. 35% runs up to $768,700, and the 37% bracket you hit as a married couple at $768,000. So not much of a change, about a 2.7% adjustment. The estate tax threshold is at $15 million, which is the highest it's ever been. That's extraordinary. So it allows a lot of small business to avoid the estate tax, not have to sell the business to pay the estate tax. I think that's a good thing. Many politicians want to do away with the estate tax because it falls really on the top 1% inordinately. And the top 1% don't mind paying the estate tax. They just don't want to pay 50%. I think people would like to pay 30% product. I think that's fair. So taking 50% of the stuff that they've already paid tax on once or twice as they've earned it, and now the government takes over half it when they die on the federal level, that rates range between 40 and 55% in my career. And the states range from 0 to roughly 18%. There's maybe 15 states that are around 16%. So you take the 40 federal, the 16, you're at 56. If you give any assets to grandchildren, grandnieces, grandnephews, then they charge the same 40% tax again on that income. So it can be very, very confiscatory. But the top 1% don't really support doing away with the estate tax. And I can assure the other 99% have no interest in doing away with it either, because it falls on that top 1%. And then the annual gift exclusion is $19,000 for 2026. Again, pretty generous, the biggest number it's ever been. So that's the amount that people can give to children or grandchildren or nieces or nephews or relatives, anybody really, and not have to file a gift tax return and not have to pay a gift tax. So fairly generous. So I think it's business as usual for the most part. And I think some changes were made to a couple of areas that are of interest. Opportunity zones in particular had a number of changes that took place that people should pay attention to as they're launching forward. If you're under the old system, you're likely grandfathered, but you may be able to do some new things going forward, or maybe extend it further. So there's some nice options built into the law. So overall, that extension of the TCJA was fairly favorable. A lot of the states have been considering a flat tax. A number of states have put in proposals for a flat tax, which I think is fairly fair given how graduated the federal taxes are and that 60% of the population paid no tax in 2023. A flat tax basically says everyone's responsible for something. Whatever you make, you're using the roads and you're using the firemen, the policemen, and all the resources of government. You should be paying something. It shouldn't just be a complete handout unless you're disabled or injured and you can't work. So I like that trend toward the flat taxes. Other states keep proposing jacking the tax up. New York, California, who doesn't want to pay more than 14%? Illinois' proposal was 12%, and that was only defeated by Ken Griffin. And he worked very hard to educate people and what an unfair tax that was, because without that tax in 2023, Illinois was the highest overall taxing state because our gas tax, our real estate property tax, all our other taxes are also sky high. Our 10.5% sales tax, one of the highest in North America. So they were trying to say, we should also have graduate rate like the other states. Well, the other states don't charge all these damn taxes that we have, nor anywhere near the same rates. So the rollout by the Illinois politicians was absolutely deceptive. They called it the fair tax when it in itself is insulting. The bill isn't supposed to be part of the vote, but it was. They called it the fair tax. It's really the unfair tax. I was aghast when I saw when you went to vote. It was just, it won't happen again. I'll personally sue to stop it if I see them do something that underhanded again. It was brutal. So it's a tough market out there. People aren't really in the mood to pay a lot more. And the capital gains also, there's a pretty low threshold for capital gains that, people can stay below it, end up with a zero capital gains tax up to about $50,000. So that's pretty generous. And for a married joint couple, it's almost $100,000. So you would pay no capital gains tax at all. So to the extent that you invest, you get a freebie. Pretty darn generous, in my opinion.
Well, Tom, we're going to take a quick break here. We'll be back for the bottom line. So think about what the bottom line here is, Tom. And now, Miami Podcast Studios, let's take it away for our word from Warren Henry. Well, I want to thank our friends at Warren Henry Automotive. They've been our sponsors for probably 15 plus years at this point. Thanks to Eric, Warren, Larry, and the rest of the team at Warren Henry Automotive for bringing the ability for us to bring folks like Tom Handler to your living room. I want to remind everybody that if you're looking to buy or lease a car, you want to get every advantage that you can. That's why you have to check out Warren Henry's flagship store at 151st and Biscayne here in Miami. I'm sure a lot of Ken Griffiths folks are buying their Land Rovers, Range Rovers, Jaguars, and Lincolns there. Up in Gainesville, well, if those folks want an Audi, they can get them from Warren Henry in their Gainesville store. Of course, they've got all the great nameplates down at their store in the Keys. And for the folks living in South Dade, they've got the award-winning Land Rover, Range Rover store in South Dade. They've got their award-winning Land Rover, Range Rover store in West Broward. So anywhere you want to go here in South Florida, you can get your car from Warren Henry Automotive, and you get the Warren Henry treatment like family, the Warren Henry Advantage. For me, I love getting my loaner car there when I'm getting my service. I want to thank Frank and the rest of the team over there that helps me get my service. And, of course, the sales manager, Ismet, who was on the show a couple of weeks ago. Remember, join my beautiful wife, Vivian, my mom, lots of my clients and friends, and of course me. We're all members of the Warren Henry family. You should be too. Always the best service, always the best price. You know it. Always Warren Henry.
Welcome back to Freed on Business. Connect with us on LinkedIn, YouTube, Facebook, and Twitter at Jim Freed or at Freed on Business, and on Instagram at Jim Freed1. Now, back to your host, Jim Freed.
All right, I've been doing a lot of business with some high net worth families here in town, doing loans with them, doing investments with them, helping them sell and refinance their properties. Reach out to me at, see my phone number, my email down there. And remember, we've got the greatest clients and the greatest contacts in the world. So let us help you add value to your family's business. And now the bottom line, the last word, the big takeaway from our special guest, Tom Handler.
Thank you, Jim. I would say in this era, which I will characterize as politically toxic, and in major cities, the police not being allowed to do their job, and most major cities understaffed with police in the first place, and then this relatively extremely leftist, radical environment that isn't reluctant to move to violence, I think families are well advised to be very cautious, to do their tax planning, their estate planning, their risk management, use security when appropriate, be very thoughtful. And the old saying, those who fail to plan to fail. So I would say it's time to assess all this, take a careful look at it, and make sure that you're conducting yourself as prudently as possible to avoid risks and liabilities, or worse, to put your family in danger, and to be proactive in your thought process and planning, and think ahead a little bit. And the time to start planning, isn't December. Many tax planning strategies are predicated on the passage of time, so you get more impact in January and February than you do in November, December. Others are not tied to that, but you're taking a lot of alternatives off the table by waiting to year end. So start early, begin the process next year, and really be very thoughtful about this, because there's a lot of good opportunities in the tax code to be taken advantage of. And that's Congress's way of subsidizing different industries and stoking up the economy. And it's been fairly effective. I'd say that's probably my thought of the day, for lack of a better word.
Well, Tom, I want to thank you as always for bringing your insights and fervor to our audience. We always love having you probably in the middle of the first quarter, and then again here towards the end of the year. I want to remind everybody, and Tom, please stick with me so we can talk a little bit in the green room. I want to remind everybody, if you missed something, Tom went really fast and threw a great laundry list of ideas. So if you want to check what he said, you can go to any of our replays on LinkedIn, Facebook, Twitch, or Instagram. Look for us at Jim Fried, at Fried on Business. Head on over to the at Jim Fried YouTube page, Apple Podcasts, Spotify, or anywhere you listen to your audio, and check out all of our past episodes. I want to thank our sponsors, Warren Henry Automotive. I want to thank our sponsors, the University of Florida Bergstrom Center for Real Estate Studies. Kelly Bergstrom gave me my first job, and yes, I'll admit it, it was in Chicago, Tom, working for JMB and Kelly Bergstrom. So yes, I stayed at that downtown dorm of Northwestern, right there on Chicago and Lakeshore Drive. So if you missed anything, make sure you check us out on our past shows. I want to remind everybody, thank you so much for spending your time with us today. You have your choice of where you spend your time, and I'm glad you chose to listen to our content. Remind everybody, the person who wants to do something finds a way, the other finds an excuse. Now go out there and make it happen. God bless you, and God bless the United States of America. My podcast studios, the rest of the show is